The Fed has not reduced rates since March 2020, at the start of the COVID pandemic. As an emergency measure, the Fed slashed rates a full percentage point to zero. You can see there. And there they remained for 2 years until inflation kicked in, and there were 11 increases, took rates to 525 basis points. It was a 2-decade high. And that's where we have seen for the last 14 months. Ryan Sweet is the chief US economist at Oxford Economics, joins me now. All right, let's just are they behind the curve? The fact is it ergo, by definition, they went twice as much as the smallest. Therefore, they were telegraphing us something.
Yeah, the Fed's never going to publicly admit that they made a policy error, but arguably, hindsight's always 2020. Looking at the employment revisions, looking at some of the softening in the labor market has probably been a little bit more noticeable than what the Fed was anticipating. So, they were probably a meeting behind the curve. Not a big deal. They were able to catch up, and I think that's may have played a little bit into the decision today to cut by 50 basis points. The last thing the Fed wants to do is fall behind the curve further and be chasing the economy through this fall and into next year. Now they're roughly, where the economy says they should be.
Which, of course, is interesting because they haven't hit 2%. I mean, the chair admitted it. They have not hit 2% on their preferred measure, or indeed on any real measure. And now they're about to stoke flames a bit. I suppose the hope is that the monetary tightening that's still there will land the plane gently. What do you think?
Yeah, well, inflation's a lagging indicator, and we know where inflation's headed over the next few months, and it's going to move closer and closer to the Fed's target. In fact, we do a nowcasting estimate, taking all the real-time data and kind of mapping it to what it means for the Fed's preferred measure, and that means it's all indications are we're going to hit 2% in September. Now, does that mean the Fed can say all clear, mission accomplished? Probably not. I mean, inflation is going to be choppy throughout the rest of the year, but we're at the point where inflation's within spitting distance of their target. The concern is the labor market, and if they wait too long to do more rate cuts, then the odds of a recession would increase.
Looking at the dot plot on the longer term basis, we're looking at a terminal rate, or at least a neutral rate of about 3.25 longer term. Now, that's a long way out, so there's many things that could happen between now and then. Is that your best prognosis, about 3.5 as being, if you will, the holding rate?
Yeah, we're right around 3%. I mean, a hair below that. The issue with the neutral rate, I mean, the Fed does need to say where this final destination is with some confidence, but it's hard to have a lot of confidence where the neutral rate is because no one really knows. The Fed doesn't know where it is. Economists, we don't know where it is. More often than not, you don't realize you've hit the neutral rate until you've gone past it. But the Fed, it's clear that monetary policy is restricting. Even with today's rate cut, the Fed still has the foot on the brake. The economy's slowing down. Inflation's moving back to their target. They just need to normalize interest rates because the job market's roughly where it should be. Inflation is getting back down to where it should be. The only thing that's been really out of whack is interest rates.
How far, just let's go right down the rabbit hole of geekery, how far the tightening, the implicit tightening that comes about from the unwinding of the balance sheet is still a drag on economic growth. We saw the Bank of England having to deal with that recently in terms of its runoff of gilt. The Fed is still committed to the runoff of the balance sheet, but that's going to still tighten monetary policy.
Yeah, it's tightening on the margin. It's not a huge source of drag on the economy. I do think the Fed's going to end this quantitative tightening sooner than they're alluding to, because as we get through towards the end of the year, even on the other side into early next, financial market conditions are going to potentially tighten. I mean, the Fed wants to end this process before they drain too many reserves. I mean, they want ample reserves into the system, and again, kind of. No one really knows where ample reserves are going to be. And they kind of learned with the repo crisis that happened several years ago, the last thing they want to do is end this process or wait too long before they end this process and run into another repo crisis. So I do think, the Fed's going to err on the side of ending quantitative tightening sooner rather than later.
I'm grateful, sir. Thank you.